Most people think retirement income is simple. You save, you withdraw, you hope it lasts. Then something like 2008 happens. The S&P 500 drops 57%. And suddenly withdrawing 4% from a $1 million portfolio doesn't mean $40,000 a year. It means pulling from an account that just lost half its value, wondering how many more withdrawals it can survive. A 2026 study from the Employee Benefit Research Institute found that 47% of retirees worry about outliving their money. Not running low, outliving it completely. And that number jumps to 62% among retirees who lived through 2008. But there is a different approach, one that doesn't require millions in the bank, one that's built to keep working when markets don't. Let's walk through 3 income streams anyone can build, and more importantly, 3 income streams that hold up when everything else is falling apart. We'll start with the simplest to set up, then build toward the one that saves you the most over a lifetime. Why one stream breaks. Before we get to the 3 streams, let's talk about why the traditional model is fragile. Because understanding the problem makes the solution stick. Here is what the standard retirement plan actually looks like. You have a 401k or an IRA. You have Social Security. Every month you pull from those sources until the accounts run dry, or you do. On paper, the math works. A 4% withdrawal rate on $1 million, adjusted for inflation, historically survived 30 years in most scenarios. But the math doesn't account for what planners call sequence of returns risk. If the market drops 30% in your first 5 years of retirement, which has happened twice in the last 25 years, your portfolio may never recover, even if the market eventually does. Because you are withdrawing from a shrinking base. The math also doesn't account for a health event that costs $80,000 out of pocket, or inflation that doubles your grocery bill over 15 years. A single income stream is a tightrope, and the wind always blows. The fix is not complicated. It's diversification, not just of your assets, but of your income sources. Streams that don't all depend on the same market, the same assumptions, the same timing. So let's build them. Income stream number 1, the dividend floor. This is the simplest to set up and the most passive to maintain. You do not need to pick stocks. You do not need to watch the market every morning. Here's the plain English version. Profitable companies either reinvest their earnings or pay them out to shareholders as dividends. When you own shares of a dividend-paying fund, you receive a portion of those profits, typically every quarter. Let's get specific. A well-constructed dividend ETF portfolio can generate roughly 4% annually. On a $300,000 allocation, that is $12,000 a year, $1,000 a month, and deposited directly into your account. Whether the market is up 20% or down 30%, those checks keep arriving. Here is the step-by-step. First, open a brokerage account if you don't already have one. Vanguard, Fidelity, Schwab, any of the major platforms works. Second, allocate 20% to 40% of your retirement portfolio to dividends. The rest stays in growth assets and bonds. You are building a floor, not a roof. Third, pick 1 or 2 broad dividend ETFs, SCHD, VYM, something that holds hundreds of dividend-paying companies, so you are not betting on any single stock. Set dividends to reinvest while you are still working, then switch to cash payouts when you need the income. That's it, 3 steps. Now we need to talk about the mistake people make here. It's called yield chasing. When you see a stock or fund paying 8%, 9%, 12%, ask yourself why. Healthy, stable companies rarely need to offer that much to attract buyers. A suspiciously high yield is often a signal that the stock price has collapsed, and the dividend cut is right behind it. Stick to broad ETFs paying 3% to 5%. Let the fund do the sorting. You collect the checks. Here is the proof that this works under pressure. During the 2008 financial crisis, S&P 500 dividend payments fell by only 21%, while stock prices fell by 57%. The income held up nearly 3 times better than the share prices because companies cut dividends as a last resort. When the market crashes, these dividends keep paying. That's the floor. Income stream number 2. Monetize what you already know. This is the stream most retirees overlook entirely, because we have been conditioned to think income means either a paycheck from an employer or a distribution from an investment account. But you spent 30 or 40 years accumulating something more durable than your 401k. You accumulated expertise, and expertise does not lose value in a market crash. A 2025 report from MBO Partners found that 4.8 million Americans over 55 are generating income through independent work, consulting, coaching, freelancing, teaching. The average annual income from this type of work among retirees, $24,000. Not from grinding 40-hour weeks, from focused, high-value work for 5 to 15 hours a week. Let me give you 3 real examples. 1. A retired HR director charges $150 an hour to conduct mock interviews and review resumes for mid-career professionals. She works 8 hours a week. That's $4,800 a month. 2. A former project manager recorded a course on project management fundamentals. 12 hours of work, one time, and it now generates $800 to $1,200 a month on platforms like Udemy, every month whether he touches it or not. 3. A retired accountant prepares tax returns from February through April. 3 months of focused work, $15,000 to $25,000 in income. The other 9 months are hers. Here is how to start. Step 1. Identify the one thing people already asked you for help with before you retired. That's your signal. If colleagues regularly came to you for advice on a specific problem, that problem is your product. Step 2. Offer it to 3 people for free or at a reduced rate. Not to build a business, to validate that people will actually pay for what you know. If they won't, adjust. If they will, you have your first testimonials. Step 3. Set up on a platform that handles the infrastructure. Upwork for consulting, Udemy or Teachable for courses, Wisant for tutoring. You do not need a website or a brand. You need one client and the expertise you already carry. When the market crashes, your expertise does not lose value. That cannot be said of a stock portfolio. Income stream number 3, the tax-efficient withdrawal ladder. This one does not create new money. It preserves the money you already have. And in retirement, preservation is creation. This is where the largest dollar impact often hides, not in earning more, but in losing less to taxes. Meet Jim and Linda. Jim is 67. Linda is 65. Between them, they have $800,000 across 3 account types: a traditional IRA, a Roth IRA, and a taxable brokerage account. They need roughly $60,000 a year to live comfortably, after Social Security. If they pull all $60,000 from their traditional IRA, every dollar gets taxed as ordinary income. Depending on their bracket, that could mean a federal tax bill of roughly $9,400. And the higher their taxable income, the more they pay for Medicare premiums. The cascade is real. Now here is the alternative. Jim and Linda ladder their withdrawals. They pull $35,500 from their traditional IRA, which exactly fills their standard deduction. That portion is tax-free. They pull the remaining $24,500 from their taxable brokerage account, of which only the gains are taxable, and at the lower capital gains rate. If they need more and have a Roth IRA, that money comes out completely tax-free. Same $60,000 in their pocket. Same accounts. Same couple. Different order. Their tax bill drops from roughly $9,400 to approximately $2,100. That's $7,300 that stays invested, compounding, extending the life of their portfolio, every single year. This is not a loophole. It's the tax code working exactly as designed. You just have to know the rules. Here is your step-by-step. Step 1. List every account you own and its tax treatment. Traditional pre-tax IRA, Roth post-tax, taxable brokerage. Write them down. Know what lives where. Step 2. Determine your annual spending need after Social Security, the gap you need to fill. Step 3. And this is where a one-time consultation with a fee-only financial planner or CPA earns its cost back immediately. Map out a withdrawal sequence that fills your standard deduction with ordinary income first, then layers capital gains on top. staying below the threshold where those gains become taxable. For married couples over 65 in 2026, that threshold is approximately $98,900 in taxable income for the 0% capital gains bracket. A fee-only planner charges $200 to $400 for a one-time plan. The tax savings from getting the sequence right can be worth that in the first quarter. When the market crashes, tax efficiency becomes even more critical, because every dollar you don't lose to taxes is a dollar you don't have to earn back from a shrinking portfolio. Putting it all together. So let's bring it all together. Income Stream 1, the dividend floor, $12,000 a year, $1,000 a month, in cash payments that arrive whether the market is up 20% or down 30%. Income Stream 2, your monetized expertise, $10,000 to $25,000 a year, working on your terms, from knowledge you already own. Income Stream 3, a tax-efficient withdrawal sequence that can save $7,000 or more annually, not by earning more but by losing less to taxes. Stacked together, you are looking at $29,000 to $44,000 in annual income before Social Security. Not a replacement for your old salary, a diversified, resilient foundation. And here is what makes this fundamentally different from the traditional approach. If the market drops 30%, your dividend income barely changes. Your consulting income is unaffected. Your tax strategy still works, possibly better because capital gains are smaller and easier to keep in the 0% bracket. No single point of failure. No single stream that takes everything down when it breaks. The market can crash. These three streams keep running. Now we reach the decision that deserves the most attention. Which stream do you start with? The answer depends on where you are right now. If you are still working, with 3 to 5 years until retirement, start with the tax-efficient withdrawal plan. Map your accounts now. Talk to a professional. Get the sequence locked in before you depend on it. This is the move that compounds. If you are newly retired with savings but wanting additional cash flow, start with the dividend floor. It is passive. It is predictable. It pays you every quarter while you focus on the other streams. If you are already retired and feeling the squeeze, start with monetizing your expertise. It requires zero capital. It generates income the fastest, often within 60 days. And it puts you back in control of your earning power immediately. Pick one, set it up, then add the next. So let me ask you this. Which of these three income streams would make the biggest difference in your retirement right now? The dividend floor, your expertise, or the tax strategy? Leave your answer in the comments. This is Senior Dossier, where we talk about the honest truths of life after 60, the ones the financial industry doesn't always lead with. If this gave you something to act on, consider subscribing. We'll be here every week.